It was not a press conference. There was no stage, no executive walking out to face a room of reporters. It was a letter. On the morning of July 14th, 2026, a block of plain text appeared on IBM's website. A few paragraphs, some numbers, the kind of document that normally gets read by 12 analysts and nobody else. By the closing bell, that letter had erased roughly $67 billion. IBM finished the day down 25.2%, around $217 a share. Worst single trading day in the history of a company that has been listed in New York since 1916. Worse than Black Monday. Worse than the dot-com unwind. Worse than anything it had survived in 115 years. And here is the part that should stop you. Nothing had collapsed. No fraud was uncovered. No product exploded. No lawsuit landed. A letter arrived, and a blue chip lost a quarter of itself. The story you have probably heard about this is simple. Artificial intelligence killed IBM. That story is wrong. Not slightly wrong. Backwards. IBM was not damaged by artificial intelligence failing. It was damaged by artificial intelligence working. Working so well and so fast that its own customers ran out of money to spend on IBM. That is the first thing we are going to prove. There are two more explanations underneath it, and they are considerably less flattering. One of them is arithmetic IBM wrote into its own product cycle years ago. The other is 4 words the chief executive put in writing under his own name, which most of the coverage that afternoon skated straight past. By the end of this, you will know which of them actually took a quarter off a blue chip in a single session, and why IBM will not be the last company to find out. Skip April and none of July makes sense. April 22nd. IBM's first quarter earnings call. Chairman and Chief Executive Arvind Krishna and Chief Financial Officer James Kavanaugh walked investors through a genuinely good quarter. At the center of it sat a machine called the Z17, a mainframe, one of those room-sized systems that quietly runs the world's transaction volume, and not a legacy relic either. IBM had rebuilt this one for the artificial intelligence era, with inference running directly on the box, milliseconds from the transaction itself. The numbers behind it were, frankly, extraordinary. IBM told investors it was off to a great start with the Z17. New capacity shipments had grown more than 100% for 4 consecutive quarters. Management called it the strongest start to a mainframe program in the company's history, so they held the line. 5% plus revenue growth for the year in constant currency. Software raised to 10% plus. Infrastructure expected to decline low single digits as the launch cycle wrapped. Confidence quantified. Hold that last number. Low single digits. 90 days later, it would print at -7. There is something else buried in that April call. Almost nobody quoted it. Walking through the business, Kavanaugh described the environment IBM was selling into. He called it a very dislocated hardware supply chain market. Read that again. In April, IBM's own chief financial officer named the exact force that would break the company's quarter 12 weeks later. Out loud, on the record, to analysts on a call anyone can still pull up. This detail changes the shape of the entire story. The popular version says IBM got blindsided by something nobody saw coming. They saw it. They named it. The guidance stayed where it was. That gap between seeing a thing and pricing a thing is where $67 billion went. The dislocation itself, though, was not IBM's doing. To understand what actually hit them, you have to leave IBM entirely. Since late 2025, there has been a global shortage of memory chips. The cause is not mysterious. Artificial intelligence data centers have been absorbing supply at a scale the industry has never had to serve before. Servers, storage, and above all, memory. When demand like that shows up, prices do one thing. They go up. Everyone who buys hardware for a living knows they are going up. In the final weeks of June, corporate technology buyers did something completely rational. They rushed, pulled spending forward, bought servers, storage, and memory early, locking in allocation before the next price increase landed. If you run infrastructure for a bank, that is not panic. That is competence. But the money had to come from somewhere. It came out of the budget lines that were supposed to be spent on IBM. the mainframe order, the transaction processing software licensed alongside it, the high-margin recurring layer that is the actual engine of IBM's profit. Understand what this means because it is the whole video. The customers did not lose faith in IBM. They did not cancel. Nobody switched to a competitor. They just had to buy something else first. Artificial intelligence never had to defeat IBM's products. It only had to reach the budget before IBM did. July 14th. Morning. IBM did something companies almost never do. It pre-announced, a week ahead of its scheduled report, with no warning, releasing selected preliminary second quarter figures. Total revenue up about 1%. Software up 5%. Consulting flat. Infrastructure down 7%, against April's promise of low single digits. In the letter, Krishna explained it. Weakness in the Z business and the software stack attached to it, primarily transaction processing. Clients shifting quarterly spend into supply-constrained infrastructure in the last weeks of June. IBM had anticipated some supply chain impact, he wrote, but not the magnitude of the reprioritization. He also noted that clients had been distracted by fast-moving, industry-wide cybersecurity concerns. All of that is environment. All of that is outside IBM's control. Then he wrote 4 words that were not. This quarter we faltered. Not the market faltered. Not conditions deteriorated. We faltered. He went further. Numerous large deals failed to close on the timelines IBM expected, and that, he said, drove the majority of the shortfall. That is not a story about artificial intelligence. It is a chief executive documenting an execution failure in public on his own website a week before he had to. The market did the math in about 90 seconds. If we stopped here, we would be doing exactly what the clip channels did that afternoon. So, what the letter also said. Red Hat's growth accelerated to 11%. HashiCorp and Confluent both performed. Confluent being the $11 billion data streaming business IBM closed in March. Distributed infrastructure, power systems and storage, grew 37% and ended the quarter with a backlog above $500 million. The mainframe itself? IBM said the Z17 program was still running at roughly 130% of the equivalent point in the previous cycle. Around 85% of installed capacity holding steady or growing. None of that describes a company being dismantled. IBM is worth just under $205 billion as I record this. There is a third explanation, and it is boring, which is probably why it got buried. IBM was lapping the Z17 launch. Sell a record number of mainframes in 1 year, and the following year has to be measured against that record. The comparison was always going to be ugly. IBM said so in advance. They simply underestimated by how much, and the transaction processing software riding on that cycle came in soft on top of it. An external budget shift IBM did not cause. A product cycle math problem IBM built itself. And an execution miss IBM confessed to in writing. 3 forces, 3 very different levels of blame. What the market was pricing that Tuesday might have been none of them. The rest of the market behaved strangely that day. Software stocks sold off at the open, then largely recovered. The broad technology tape finished firmer. And the categories IBM blamed, servers, storage, memory, were among the strongest performers of the session. Contagion, contained. IBM fell alone, which suggests investors did not read that letter as a warning about enterprise software generally. They read it as a verdict on IBM specifically, on whether the middle position Krishna spent 6 years constructing actually holds. The position was elegant. IBM as the bridge. Old corporate systems on one side, artificial intelligence and eventually quantum computing on the other, IBM collecting a toll in between. It works beautifully while customers are funding everything at once. It works considerably worse when customers have to choose. If artificial intelligence infrastructure keeps eating the budget first, the bridge gets paid last. That is what July 14th actually asked. Not whether IBM is dying. IBM is not dying. Whether high-margin enterprise software, the most profitable business model modern technology ever produced, has quietly become the thing you fund with whatever is left over. This was not the first warning shot either. Back in February, IBM shares fell 13% in a single day. worst since 2000. The trigger was Anthropic saying its models could help modernize COBOL, the decades-old language running on IBM mainframes. IBM's software chief pushed back publicly, arguing that artificial intelligence strengthens the case for the mainframe rather than weakening it. He may well turn out to be right. Doesn't change the fact that the market has now taken 2 large bites out of IBM in 5 months, over the same anxiety. Since July 14th, letters have started moving in the other direction. Huggins Berman, Levi and Korsinski, Bleichmar Fonte and Ald, Schall, Frank R. Cruz. Shareholder firms announcing investigations into whether IBM's earlier statements about the Z-cycle and its 2026 outlook were misleading. Be careful with this. These are plaintiff-side firms, and their notices carry attorney advertising labels. They open after almost every large drop. No securities regulator has acted here. There is no finding of wrongdoing against IBM. One of those firms, though, is pointing at something very specific. Kavanaugh's April statement expressing confidence that this would be IBM's strongest mainframe cycle, which puts us back at the only question that ever mattered. On April 22nd, when IBM's finance chief described a very dislocated hardware supply chain and left the guidance untouched, was that optimism, or was that a choice? IBM answers on July 22nd. Full results, first real guidance since the letter. HSBC has already cut the stock to reduce with a $191 target, and prediction markets were pricing roughly a 1 in 4 chance of a beat. Watch one thing on that call, not the revenue line, whether the missing deals reappear in the third quarter outlook. If they come back, this was a bad quarter. If they do not, then something has permanently changed about who gets paid first in enterprise technology. IBM was just the first blue chip to find out. It will not be the last one.